Good morning, all of you. So, accounting standards. Last lecture we have completed basics. So, let's begin with the accounting standard first. Accounting standard 1. Disclosure of accounting policies. Disclosure means to show the accounting policies to be followed by us. Irrespective of the extent of standardization, diversity in accounting policies is unavoidable for two reasons. First one, accounting standards cannot and do not cover all possible areas of accounting, and enterprises have freedom of adopting any reasonable accounting policy in areas not covered by standard. Is irrespective of the standardization. Standardization is one of the characteristics, one of the benefits of following accounting standards. There will be two situations, two reasons due to which diversity can be possible. First one, accounting standards cannot and do not cover all possible areas. Okay, all possible areas cannot be covered under accounting standards. Second one, since the enterprises operate diverse situations, it is impossible to develop a single set of policies applicable to all enterprises for all time. There are so many areas, so many situations that can be happen while doing business. So we cannot say that this set of areas will be applicable to business and nothing more than that will be applicable to that business. Okay. Accounting standards therefore permit more than one policy, even in areas covered by it. Differences in accounting policies lead to differences in reported information, even if underlying transactions are same. The qualitative, not quantitative, okay, the qualitative characteristic of comparability of financial statements therefore suffers due to diversity of accounting policies. Since uniformity is impossible and accounting standards permit more than one alternative in many cases, it is not enough to say that all standards have been complied with. For those reasons, Accounting Standard 1 requires enterprises to disclose significant accounting policies actually adopted by them in preparation of their financial statements. Such disclosures allow the users of financial statements to take the differences in accounting policies into consideration and to make necessary adjustments in their analysis of such statement. The purpose of Accounting Standard 1, disclosure of accounting policy, is to promote better understanding of financial statements by requiring disclosure of significant accounting policies in orderly manner. As explained in preceding paragraph, such disclosures facilitate more meaningful comparison between the financial statements of different enterprises for same accounting period. So for accounting standard 1, AS1 facilitates, promote better understanding of financial statements, and that's why various disclosures of significant accounting policies will be given in accounting standards 1. For example, you are following accrual basis, so that accounting policy that will be given as a disclosure, okay, as disclosure. The standard also requires disclosure of changes in accounting policy. For example, if you change your accounting policy next year, so you have to disclose it in the notes to accounts. Notes to accounts means while preparing notes after completion of financial statements, profit and loss account, balance sheet, you prepare notes. So you have to write down in the notes that we have changed the accounting policies from this to this. Users can compare financial statements of the same enterprise for different accounting periods. This is purely theoretical. Accounting standard 1 is purely theoretical. The standards applies to all enterprise. Now, fundamental accounting assumptions. So those who have cleared foundation or those who have completed study of foundation will know what is the meaning of fundamental accounting assumptions. How many parts are there of accounting assumptions? First one, going concern. Second one, consistency. And third one, accrual. GCA, going concern, consistency, accrual. 3 fundamental accounting assumptions. Okay? Fundamental mean basics, basic of accounting assumption. Basic accounting assumptions are going concern, consistency, accrual. Let's discuss one by one. First of all, if it is followed, not required to be disclosed. Why? If it is followed, it will not be required to disclose. It is not required to be disclosed. Why? Because these are the basic standards and you have to follow them. If you are not following these standards, assumptions, then disclosures will be required. Second one, if not followed, disclosure required in financial statement. Okay. First one, going concern. The financial statements are normally prepared on the assumption that the enterprise will continue its operations in the foreseeable future. Foreseeable future means n number of years. There is no limit. Okay. Let me give you an example. After completion of your bachelor's, your master's, chartered accountant, all the courses, you have started one business. Okay. You have started one business. So you assume that, okay, I will do this business for 5 years. I will do this business for 5 years. After 5 years, I will shut down my business. Do you assume? That after completion of 5 years or after completion of 10 years, I will not run this business. I will close my business. Is it happen? Class? Do you assume like that? After a certain period of time, I will not do business. I will close my business. Or for example, if your father is doing business, so will he think like this? After a certain period of time, I will close my business. So will you prepare your financial statement like this? So answer is no. Why? Because the fundamental assumption is that your business will run for foreseeable future. Foreseeable future means n number of times, n number of years. There is no end. And neither there is intention neither there is intention nor there is any need to materially curtail the scale of operations. Okay. The fundamental assumption is that we will expand our business, not reduce our business, not curtail our business. Okay. We will definitely expand our business. Financial statements prepared on going concern basis recognize, among other things, the need for sufficient retention of profits to replace assets consumed in the operation and for making adequate provisions for settlement of its liability. So, those financial statements prepared on the basis of going concern will recognize, among the other things, like need of sufficient retention of profit. Sufficient retention of profit means provision. You will do certain provision. Like after a certain period of time, your machinery will be of no use. So you have to purchase another machinery. You have to make some provisions of tax, provisions of expenses. Okay. So going concern, if you are not following going concern, you will not do the provision. Why? Because it's not possible. If you are not streamlined to do the business for foreseeable future, then how can it be possible to do the provision? And one more thing, if it is not your fundamental assumption, going concern, okay, now understand this thing. If followed, not to be disclosed. If not followed, it is to be disclosed. Now, for example, Reliance Limited. Reliance is not following this accounting standard. For example, okay? For example, Reliance is not following going concern assumption. Then, if Reliance is not following going concern, it has to disclose in financial statement that we are not following going concern. We will shut down our business after a certain period of time. So, what will be the impact of this disclosure? No one will be interested in investing this. No one will be interested in purchase of shares of Reliance Limited. Okay, no one will purchase the shares of Reliance. Why? Because you are disclosing that you are not following going concern. Going concern means you think back of your mind it is something is running like we will not do business after this year. अगर हमारा business नहीं हुआ तो क्या होगा? After certain period of time, what will be happen? Okay. So if you are not following basic standards, fundamental accounting assumption of going concern, then you have to disclose it. Clear now? If not followed, then you have to disclose. Similarly, consistency. The principle of consistency refers to the practice of using same accounting policy for similar transaction in all accounting periods. Consistency means, let me give you one basic example. For example, you are preparing for IPCC. IPC means intermediate exam. CA intermediate exam. Okay. And on the first day of learning, you studied for 8 hours. You studied for 8 hours. Next day, you studied for 7 hours. Third day, you studied for 1 hour only. Next day, you again studied for 4 hours. 5 hours. Next day, you haven't studied. Why? Because that was Sunday. So you haven't followed. You haven't studied anything. Next day, you again studied for 1 hour. So this is not an example of consistency. You are not consistent. Okay. So this is one of the fundamental accounting assumption that you have to be consistent. The principle of consistency is referred to the practice of using the same accounting policies for similar transaction. Similar transaction means sale transaction. For example, sale transaction. For some transaction, you follow cash basis. For some transaction, you switch to accrual basis. Again, next year you again switch to cash basis. You know now cash and accrual. Cash basis means you record the transaction whenever you receive the money. And accrual basis means you record the transaction when transaction happens. For example, you sell the you sell on 14th March and you receive the money on 1st April. So if you are following accrual basis, you will record the transaction on 14th March. Why? Because you have raised the bill on 14th March. But if you are following cash basis, and you have to record the transaction on 1st April. So if you are not consistent in following these policies on similar transactions, then you have to disclose. તમારે disclose કરવું પડે કે ભાઈ we are not following the same transactions, the same policies. The consistency improves comparability of financial statements through the time. An accounting policy can be changed if the change is required by statute, by accounting standard, or for appropriate presentation of financial statement. So only and only you can change the accounting policy for these three reasons. Only these three reasons allow you to change the accounting policy. First one, by statute. By statute means law, by law. If any law came into existence and you have to switch to another accounting policy, then it will allow you to change. Then by accounting standards, if accounting standards changed and you have to change your accounting policy, then also it will be allowed. And third point, for more appropriate presentation of financial statements. Only these three reasons allow you to change your accounting policy. Clear? Consistency, going concern and consistency clear, class? Chalo, please reply. Out of 12 students, I got reply of 7 students. Jai, are you there? Ishan. Jai, Ishan. Then Farjan. Then Okay. So, third point, third fundamental accounting assumption. So, if you are not disclosing anything, okay, regarding going concern, regarding consistency, then it will be assumed that you are following these accounting assumptions. Okay, it is not necessary to disclose every time that we are following going concern. Every year we are following going concern. We are following going concern. Arey bhai, you are following going concern. That's why you are doing the business. Okay. No one will do the business to close the business. Okay, if you are not consistent, then you have to disclose. If you are consistent, then it's okay. You are not supposed to disclose all the time that you are consistent, you are consistent, you are consistent. Okay, now third one, accrual basis. Under this basis of accounting, transactions are recorded as soon as they occur. As soon as they occur, whether or not cash or cash equivalent is actually received. I have given you the example. Okay. Whenever transaction occur, you will record it. For example, you sold the stock on 15th June. 15th June, but you received the money on 15th July. When you record the transaction, obviously when you raise the bill. So when you raise the bill 15th June. So the date of recording will be 15th June. This is what the accrual basis says. You haven't received cash or cash equivalent, but you record the transaction. Okay. Accrual basis ensures better matching between revenue and cost, and profit and loss obtained on the basis reflects activities of the enterprise during the accounting period rather than cash flows generated by it. Now, accrual basis will not give you anything regarding cash flows. Okay. How? For example, you are checking the June month business. You are checking your business in June month, June 2021. So it will reflect you that you have sold your total sales for the month of June is 50 lakh rupees. 50 lakh rupees. But it will never give you the idea about cash flow. Okay, out of this 50 lakh rupees, how much you received. Okay, accrual basis will not give you the cash flows generated. It will give you the transaction of revenue, cost, profit and loss. For example, your purchase for this particular month, June month, is, let's say, 45 lakh rupees. And your expenses are, let's say, 1 lakh rupee. So what will be your net profit? What will be your net profit? Your sales is 50 lakh rupee, your purchase is 45 lakh rupee, and your expenses is 1 lakh rupee. What will be your profit? Chalo class, reply. I have written in chat box. Chalo class, what will be the net profit? Very easy. 4 lakh. Some students are very active. They reply immediately. So 4 lakh rupee. So that is what accrual basis ensure. Accrual basis ensure better matching between revenue and cost and profit and loss account. Now, if I ask you, what is your cash flow? What is your cash flow? You will not be able to answer me. તમને ખ્યાલ આવશે? What's your cash flow? No. Sir, we know that sales is 50 lakh. We know that purchase is 45 lakh. But we don't know that how much we received and how much we spent. So accrual basis will not give you the idea about cash flow generated. Okay. It will not give you the idea of cash flow generated. While accrual basis is more logical approach to profit determination than cash basis of accounting, it exposes an enterprise to the risk of recognizing an income before actual receipt. Okay, it exposes the enterprise to the risk of recognizing. It will be risk, na? Are you getting? Sir, we are recording transaction on 15th June at the time of sell, but we don't know that my debtor will give me the money or not. Okay, he will give me my money or not. Without knowing, I will record my transaction. Yes. For example, you have sold to ABC Private Limited. Okay, ABC Private Limited on 15th June of 1 lakh rupee. Now you don't know that ABC Private Limited will give you the money or not, but you record the transaction. So it exposes of enterprise. What exposes the risk of recognizing an income before actual receipt. Now if you know that GST, you have to file your GST monthly basis. So after the end of the month, after completion of month, you will file the GST return and you will show that 15th June, ABC Private Limited, bill number this, I have sold 1 lakh rupee. For example, 18% GST will be applicable. So what will be the total amount? 1,18,000. So 18,000 will be the GST. So you will pay the GST. You will pay the GST, or you will set off the credit, ITC, input tax credit. Okay. So after completion of month, you come to know that ABC Private Limited is bankrupt. It is now your bad debt. So it exposes the risk of recognizing an income. So this is the disadvantages. One of the disadvantages of accrual basis. The accrual basis therefore overstate the divisible profits, and dividend decisions based on such overstated profit lead to erosion of capital. Okay? It will lead to erosion of capital. For this reason, accounting standards require that no revenue should be recognized unless the amount of consideration and actual realization of consideration is reasonably certain. Reasonably certain. But sir, how can we come to know that it is certain or not? Whether I will receive the money or not? How it is certain? Arey bhai, you are doing business with ABC Private Limited since 10 years. તમે 10 વર્ષથી business કરો છો ABC Private Limited સાથે. So you know that after completion of 1 month, ABC Private Limited will give you the money. This is the general practice. So now it is certain or not? Yes, sir. Now it is certain. Okay, then record the transaction. Clear? Now you will record the transaction. Now, despite the possibility of distribution of profit not actually earned, accrual basis of accounting is generally followed because of its logical superiority over cash basis. So it is logically superior. Okay, MCQ can be asked. Which one is logically superior? So accrual basis. Section 128, subsection 1, clause 3 of Companies Act makes it mandatory for companies to maintain accounts on accrual basis only. So Companies Act says you have to maintain your accounts on accrual basis only. Why? Because it will helpful to compare the accounts. It is not necessary to expressly state that accrual basis of accounting has been followed in preparation of financial statement. In case any income or expense is recognized on cash basis, the fact should be stated. Clear class? Clear or not? Hello, reply time. Okay. The accounting policies. Now, accounting policies refers to specific accounting principles and the methods of applying those principles adopted by the enterprise in preparation and presentation of financial statements. Accountant has to make decision from various options for recording or disclosing the items in the books of account. For example, inventory. Inventory can be recorded by FIFO method, first in, first in, first out, or weighted average method, or LIFO method is there. Cash flow statement, either you can record by way of direct method or indirect method. So this list is not exhaustive, it is endless. So many items, so many disclosures are there, so many methods are there. So we have to study accounting standards for each and every point. For every item, right from the valuation of assets and liabilities to recognition of revenue, providing for expected losses for each event. Accountant need to form principles and evolve a method to adopt those principles. This method of forming and applying accounting principles is known as accounting policy. So, which principles you will apply? The method of forming and applying that accounting principles will be considered as accounting policies. As we say that accounts is both science and art. Account is science and art. It is science because we have some tested accounting principles which are applicable universally, but simultaneously it is an application of these principles. The application of these principles depends on the personal ability of each accountant. Since different accountants may have different approach, we generally find that different enterprises under the same industry different accounting policies is followed. Though ICAI along with the government is trying to reduce the number of accounting policies followed in India, but still it cannot be reduced to one. You cannot reduce to one. Let me give you one example why. For example, valuation of stock. Valuation of stock. Inventory. Stock or inventory, both are same. Here, inventories. Generally, majority of business are following FIFO method. FIFO method, do you know what is FIFO method? Class? You have studied earlier, FIFO, LIFO. Okay. So, FIFO means first in, first out. It means whatever comes in first will be sold first. But there are certain industries in which you cannot follow FIFO method. You cannot follow FIFO method. Example is bakery item, milk products, bakery item, milk product. You cannot follow FIFO method. For example, Monginis. Let's say in Monginis there are 10 cakes right now in stock. 10 cakes are in stock. Okay. I went to the Monginis and asked him for 1 kg cake. Ask him for 1 kg cake. So he will give me the cake which is first came in the shop or last came in the shop. મને કઈ કેક આપશે? ફર્સ્ટ આવી છે કે લાસ્ટ? ઓબ્વિયસલી લાસ્ટ. ફર્સ્ટ હોય ઈ મને આપે, it means that is not fresh cake. Okay, that is not the fresh cake. So after eating that cake, what I will say? I will never go to this shop again. Why? Because he sold me outdated cake. Okay, expired cake. મજા જ ન આવી આ કેક ખાઈને. આવે? ખ્યાલ આવે છે? So you cannot follow one particular policy for all the industries. This is one basic example. There are so many examples that can be formed. Okay, so ICAI is trying, along with the government, is trying to reduce the number of accounting policies followed in India, but still it cannot be reduced to one. It cannot be reduced to one. Now, selection of accounting policy. Financial statements are prepared to portray. Portray means to picture a true and fair view of a performance and state of affairs of enterprise. In selecting a policy, alternative accounting policies should be evaluated in that light. In particular, major consideration that govern selection of particular policy are prudence. Now, prudence means typical Gujarati of prudence is dahapan. Dahapan. Now, which one is advisable? Prudence means, now, in view of uncertainty associated with the future events, profits are not anticipated. Anticipated means it cannot be predicted. But losses are for as a matter of conservatism. Loss can be predicted. Loss can be predicted. Provision should be created for all known liabilities and losses, even though the amount cannot be determined with certainty and represents only the best estimate in the light of available information. The exercise of prudence in selection of accounting policies ensures that profits are not overstated, losses are not understated, assets are not overstated, and liabilities are not understated. Okay, so if you are following the prudence says that provision will be done for the profit, loss, assets, liabilities, but you cannot do this by overstating the profit. તમને એવું લાગે છે કે ભાઈ 5 lakh rupees profit થશે. It feels that profit will be 5 lakh rupees only, but you overstated the profit in books. Like next year it will be 8 lakh rupees. So it is not prudence. It is not the prudence. You cannot overstate the profits. And similarly, you cannot understate the loss. You know that next year around 2 lakh will be the loss. But you say that no, only 50,000 loss will be there. You cannot understate the loss. Similarly, you cannot overstate the asset and you cannot understate the liabilities. Here, let's discuss one example. A common example, most common example of exercise of prudence is in selection of accounting policy is policy of valuation of inventory. valuing the inventory at lower of the cost or net realizable value. Now, your accounting standard 2. Accounting standard 2 is valuation of inventory, in which we will discuss that inventory is recognized at cost or NRV, whichever is lower. Cost or NRV. NRV means net realizable value, whichever is lower. So it is one of the policies. So now in this example, suppose a trader has purchased 500 units of certain article. For example, 500 units purchased of something like article A, B, C, whatever it is. 10 rupees per unit. Per unit 10 rupees. So total it will be 5,000 rupees. He sold 400 articles for 15 rupees. Okay. 400 articles sold. So closing stock will be 100 rupee. 100 units. Okay. 500 purchased. 400 sold. 100 will be the closing stock. Now, if net realizable value per unit of the unsold article is 15 rupees, then the trader should value his stock at 10 rupees only, thus ignoring the profit of 500 rupees. Sir, no समझाना. जो 10 rupees cost. Now 100 units stock, 100 units stock માં પડ્યું છે. Now if he record, now after selling, now 100 units are there and price is increased. The net realizable value of these units are increased to 15 rupees. NRV increased to rupees 15. So now what accountant will do? Accountant will record at 10 rupee or accountant will record at 15 rupee. So prudence says that you will record at rupees 10. You will record at 10 only. And you will ignore the 100 units. You will ignore the 500 rupees profit. But how 500 rupees came? Simple. 15 minus 10 multiply by 100 units. Multiply by 100 units. You will come to 500 rupees profit. But sir, how it is profit? 10 rupees purchase price, you are recording at 15, so obviously it is your profit. You are increasing the value of the stock. Are you getting this? Now in this example, if NRV per unit of unsold article is rupees 8, now if it is at 8 rupees, then the trader should value the stock at 8 rupees only. Now if it is reduced from 10 to 8, then you will record at 8 only and recognize the possible loss of 200 rupees. Now if 10 rupees is your cost, but net realizable rupee is 8. So 10 minus 8 multiplied by 100 units, it will come to 200 rupee loss. 200 rupee loss. But you will recognize it. Okay. The same calculation is given over here. Profit in case of valuation at 15. So here you check 10 rupees and 10 rupees. 500 purchase 10 rupees and less 100 closing stock 10 rupee. So your profit will be 2000. Here again, if net realizable value is 8 rupee, then also it will be considered 8 rupee here, 8 rupee. Clear થાય છે બધાને? Should I explain this in Excel sheet class? Or is it clear? Okay. Please repeat in Excel sheet. We have still 3 minutes. Now, here is said that you will record the inventory at lower of the cost or NRV. Okay, you will record the cost inventory at cost or NRV, whichever is lower. Okay, so now you have closing stock of 100 unit. How this 100 came, that is clear or not? 100 unit કેવી રીતે આવ્યા એ તો ખ્યાલ આવ્યો ને. Purchase 500, sales 400, so purchase minus sales, it will be 100. Okay, 500, 400, so the balancing figure will be 100 units. Okay, clear? Now, how to record this? So simple, cost or NRV, whichever is less. Cost or NRV, whichever is lower. So here, whichever is lower, cost is lower, so rupees 10. Rupees 10. And here, which one is lower? So 8. It is, here it is cost. Cost is lower. And here, NRV is lower. So we will record it NRV. So 100 unit multiply by 10, 1000. And here, 100 unit multiply by 8, 800 rupees. Closing stock amount 1800. Now here it is said the trader should value his stock at 10 and thus ignoring profit of 500. Ignoring profit of 500. How profit? For example, if I record this at 15 rupees, and 1000 multiplied by 15, 100, sorry, 100 multiplied by 15, it will be recorded at 1500. So it will result into the profit 1500 minus 1000. It will result it into the profit, but we are ignoring this profit. Why? Because cost or NRV, whichever is lower. Now in this case, your stock is of 10 rupee. Stock is તમારો 10 રૂપિયાનો છે. Stock is of rupees 10, but you are recording it at rupees 8. Why? Because cost or NRV, whichever is less. So 100 unit multiplied by 8. So you are doing the loss of 200 rupees. તમે તો 200 રૂપિયાનો લોસ કરો છો, but stock 10 rupees માં purchase કર્યો છે, you are recording at NRV. Cost or NRV, whichever is less. Okay, That is what given over here. That is what is given. But it is showing the profit. But we are not concerned with the profit. We are concerned with the recording closing stock item. Closing stock કેવી રીતે record થાય? Clear? So in this case, closing stock will be recorded at 1000 rupee, and here closing stock will be recorded at 800 rupee. Clear? કે નહીં બધાને? નેક્સ્ટ લેક્ચર આપણો જ છે, ચિંતા કરો માં. Is it clear or not? No હોય તો હજી કહેજો. Okay. I will repeat this example again in next lecture, Monday. Okay, don't worry. So for this lecture, please write down the enrollment number. Okay. Thank you all of you.